So the Fed raised rates, but why did mortgage rates drop? The U.S. Federal Reserve raised its key Federal Reserve funds rate, or Fed funds, a quarter of a percentage point on Wednesday, March 13th, for the second time in the year, citing economic growth, job gains, and confidence. Then, the mortgage market did something odd. Mortgage rates dropped. The yield in the 10-year U.S. Treasury peaked at 2.6 the day the FOMC chair Janet Yellen announced the Federal Reserve would raise its key Fed funds rate to 1% from 0.75. So now what's the reason mortgage rates dropped? Consumer debt gets its pricing from D.C., and mortgages get their pricing from Wall Street. So they get their money from different places. Fed funds is the interest rate the Federal Reserve charges its member banks for short-term loans, and there's no direct correlation between the Federal Reserve raising their rates and then mortgage rates. So in other words, Fed funds is going to have an effect on your credit card rates, your consumer rates, your HELOCs, but anything that's tied to prime. But again, it has no effect on mortgage rates. So what do I do if I'm in the mortgage market? The best indicator to find out what's happening in the mortgage rates market is to Google the 10-year U.S. Treasury. So you can Google it, go to CNBC or Yahoo Finance, and that will give you a better indication of the trend in the mortgage market.